everybody, and welcome to this September 20th edition of our series of short video on the state of the economy. So it's fall, a little bit of volatility, so it's more important than ever to discuss with our chief economist, Stéfane Marion. Hello, Stéfane.
Good morning, Martin.
As usual, let's start by looking at the state of the sanitary crisis. We see some kind of stabilization, Stéfane.
Yeah, it's great news, Martin. Since we last spoke, and at the time we were concerned about the spike in new cases across OECD economies, the good news, it seems to be stabilizing. Yes, it did hit very high levels in Israel, for example, but it's stabilizing. And the good news, Martin, is the US, the UK, and even Canada are showing limited spike at this point in time. So it seems like there is some improvement since we spoke a month ago.
And let's look at the impact of this fourth wave, Stéfane. The difference between anticipation and reality, we're seeing some negative here.
Yeah, so things are stabilizing, Martin, but it doesn't mean that they have not had an impact on some of the economic reports that have been published over the past month. And clearly, we are now in the period where the data is coming in slightly below expectation. It's not negative growth, Martin, but clearly some impact on expectations. And you can see that China and US have been dragged down by the fourth wave of COVID cases that has impacted certain sectors of the economy and the global supply chain. And if China and US goes down, then so goes the world, obviously. So for the first time since the start of the pandemic, yes, the economy is coming in below expectations.
So you just mentioned it. It's very important. It's not that we are seeing negative numbers, but negative surprises. And let's talk about a pretty good sector, employment.
Yes, I'd be more concerned, Martin, if we had negative economic surprises that were accompanied by a decline in employment. This is not the case. If anything, employment continues to improve in both Canada and the US. And for Canada, Martin, we're only less than 1% from the pre-COVID peak on total employment. The US lagging Canada on that front, but still less than 4%. So things are improving because if you have job creation, it does suggest that consumer spending will help the global expansion in the coming weeks, coming months.
Well, let's look at one of the negative impact of this crisis. We're seeing some serious bottlenecks in global trade.
So you have a fourth wave of COVID cases, Martin. Jobs are still growing. People want to buy, but certain sectors have been shut down in certain in countries around the world. We saw impacts on Chinese transportation sector this summer. So all in all, Martin, people want to buy products. It's still out there, but the global supply chain is negatively impacted. Everybody wants to restock their shelves. So the issue now is global supply. Transportation costs are very, very high. And Martin, this is something we haven't seen for a while, but it could injure.
So the big question is this big spike in the cost of shipping goods, could it subside quickly?
It's a great question, and many central banks are arguing that it will subside relatively quickly. But Martin, if you look at this slide that shows inventories at U.S. retailers, they're so depressed. They're where they were back in 2016. So just to bring them back to their pre-COVID level, and I think they'll aim for that, Martin, those retailers, you're talking about a period of maybe 18 to 24 months in the current context where the global supply chain is not working as smoothly as we'd like. So yes, it is likely to last a little bit longer than we thought it would just a few months ago.
So all those chips or bicycles that you've been waiting for could take a while before we get them. This is having all kinds of impact on the economy, Stéfane, and fundamentally on economic growth.
Well, we're feeling it in Canada, Martin. Actually, if there's one place where growth was negative recently, with negative economic surprise, it was Canada, because real GDP came in at down 2% during the quarter. It was not the best performance, one of the worst performance in the G7. And the issue on that one, Martin, was really the reflection that our export sector was hit very, very hard because of semiconductors, other parts also that impacted the automobile sector. So negative real GDP was observed in Canada in the second quarter, but I want to reassure you, Martin, is that whatever we were selling, at least we were selling at a higher price. So real GDP was negative, but nominal GDP was up 8%. That's a big difference, and that is a key driver of profitability and government revenues. So there's a reason why the governments are promising a bunch of spending during this federal election, because they have nominal GDP growth from which to spend. And on that front, nominal GDP in Canada is the best in the G7. So yes, there's an impact. You can see the impact of the global supply chain on the Canadian data.
Let's talk about inflation, because our viewers are asking us a lot of questions about it. Some people are saying that the Fed could be making one of its biggest historical mistake by not addressing these big trends in inflation. What are your thoughts on this, Stéfane?
Well, Martin, it's not just the Fed, right? All these central banks have been arguing that, it would take a while for inflation to come back and the global supply chain would normalize relatively quickly. If it doesn't, Martin, we can detect the inflationary pressure. Actually, it's in our face right now. If you look at the Canadian CPI numbers, inflation data showing 4% consumer price inflation, the blue line on that chart, something we haven't seen in quite some time. And at the same time, even if you were to exclude energy and food, which are quite volatile, you're still talking inflation at 2.6% in Canada, well above the 2% range for the Bank of Canada. In the US, Martin, we're talking 5%. So here's the story on central banks. We do know that we're going to get more fiscal stimulus in both Canada and the US in the coming quarters. Is there a need for the central banks to provide as much monetary stimulus when job creation is turned out to be positive, and at the same time we have this government stimulus coming in the pipeline? Is that too much stimulus, Martin? And I think that is something where the central banks might become less predictable in the coming weeks. I think they will be forced to address the fact that they can't continue with quantitative easing as aggressively as they have done in the past few quarters. So yes, inflation is becoming more of a challenge for the central banks, I believe.
The other subject of great interest to our viewers, Stéfane, is obviously the stock market flirting or at new highs these days. Yes, interest rates are low. We documented this very well in the past, but what is the situation for profit anticipation?
They're very high, Martin. It's as if people continue to think that, the global supply chain will normalize really quickly and corporations will benefit from the ability to sell at higher prices. So don't get me wrong, Martin. The stock market was right to rebound because profits, you can see on the slide, were above pre-COVID level in just 18 months. This is fascinating. It took a full decade to get profits back to their pre-recession peak in the previous cycle. It's coming back really quickly. But that's why the stock market is as high as it is right now. In terms of profit anticipation, Martin, you're absolutely right to raise the issue on that front, because expectations are for 16% growth in profits over the next 12 months.
16.
1.6, yeah, that's pretty aggressive in a context where the global supply chain has yet to normalize, and central banks become less predictable. So I think maybe that sets the stage for maybe a period of consolidation in markets where people have to reassess their profit expectations for next year, given the factors that we've been mentioning.
And if we put this in historical perspective, it wouldn't be a big surprise.
No, because at the end of the day, you're looking at this slide and you're saying, well, we've had 235 days in the U.S. without a 5% correction in the market. We're just talking consolidation, Martin, when we talk about 5% correction. We're not talking a bear market. This is already the 8th longest rally in U.S. history since the early 1960s. So it's a rally that's long in the tooth already. So if central banks become less predictable and the global supply chain is impacted, as you reassess your profit expectation, it's natural that we would see this period of consolidation. So let's just be wary of the next few weeks, which could be more volatile.
Indeed, that's our conclusion. Let's watch for central banks, for global trade, for the stock market with profit anticipation. We could see some volatility. Thanks for tuning in. Thank you, Stéfane.
Thank you.
We'll see you in 1 month. Take care.